What's up, and welcome back to another episode of How to Invest in Commercial Real Estate.
What's up, man?
Yeah, it's been a week or two.
It's been a week or two. Yeah, tell us.
Thunder NBA championship. That's what's up.
What's up? Hey, boys, I tried to tell you, one of the best teams in history. Got some hate mail, got some tough comments, but they're world champs, and there's nothing anybody can say about that.
There's a lot of non-believers out there. They didn't believe it. But I went to Game 7 because I'm a believer.
Yeah. It was awesome, man. And Oklahoma doesn't win world championships in anything, so this is a big deal for us.
Probably the first one.
Yeah.
Pretty nuts. Shea had quite the season. Signed the biggest Supermax contract.
We've got him tied up for another 6 years.
And then I read an article in Tulsa World that Oklahoma City Thunder bought the team for like $350 million. Yeah. Estimates are in the $4 billion range right now.
There goes my shot at buying part of it.
Well, yeah, they were just talking about how the group of shareholders will now have some pressure put on them to not sell it, you know, and then does the buyer of it, what do they do? The new stadium's being built downtown. The city committed to that. So that's opening like 27, I think. That'll be nuts.
I think it's opening up right next door, isn't it? Aren't they knocking down the Cox convention and building the new Thunder Stadium right next door to the existing one?
Which is crazy.
And it has the same amount of seats.
What?
Well, you don't go bigger because then you don't get a good view. I mean, basketball, there's a limit to how far you can put people to have a good experience.
Stadium, though.
The one we have is great.
Yeah,
it is great.
Apparently, you want to waste money.
There's so many basketball games that they just can't get concerts in there, probably. They can't.
Oh, maybe.
Yeah, they're losing all the good concerts to Tulsa, which I'm not sad about.
Yeah.
I'm seeing those good concerts.
Well, what else we got?
It's distribution time.
Yes.
Second quarter.
Distribution.
Nice. Pew, 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 pew. Do we still do the video? Anyway, that was fun. We need to do that again.
We need to do it again.
Shoot out the $100 bills.
Yeah, that's always fun.
Yeah, so let's see. Precision Equity, we have 2 properties that we're not going to be sending distributions out. Everything else is getting distributions. What about Criterion?
I was going to say there's 2 properties that are not paying out, but I can only think of one. Because St. Louis is paying out now.
So just
Plaza West. Yeah. But we returned all the equity, so we don't need to pay out a distribution. Right. So sucks to suck. We win.
Well, good.
Not that it's competition or anything.
You know, another thing we've got a new property closing next week.
It's not a competition, but if it was, we'd win.
If it was, of course, we'd be winning.
I'd moved on from whatever you were talking about.
Brian and I are obviously dwelling on it
to talk about.
We did. Totally derailed on all of those. Oh yeah, we're buying more shit next week. Sorry, totally derailed. Again, it's in Fort Worth, Trail Lake Plaza. Equity raise sold out super fast. We were kind of like half raised before we launched it, though. We're always selling the next deal when the previous one fills up. And if you're always committing to our deals, we're just nice and say, hey, you want to look at the next one? And most of the time, they're nice and say, yeah, give me the same investment. So a lot of times we're fundraising these deals. So they sell out a little bit faster, if you've ever noticed that.
A case in point is we have a portfolio closing at the end of July, and I believe it's already sold out.
Yeah. Oh, yeah. Yep.
So the next opportunity someone's going to have to get in a deal will be August.
On deals we're getting in contract right now. I signed one today on a deal in Atlanta. That's super exciting. We're probably 75 days out from that. Smaller deal. And then we're about to sign... we just signed the contract last week on the another deal in Michigan. But anyway, we have a lot in the pipeline. But yeah, next opportunity to get involved is August, you know. We did have somebody drop out, though, of the Texas portfolio. So if you want to scoop that up, shoot me an email. Say I'm picking up the dropout. Just leave it there. People drop out all the time. It sucks to suck.
Well, so we came up with a topic today to help teach you guys some things about taxes. So, Brian, hit us.
Okay, so tax advantages of investing in commercial real estate, right?
Yeah, we've talked about this before, that taxes are most likely your biggest lifetime expense, so you need to become an expert at it. If you don't know about taxes, if you don't understand the tax code, if you don't understand how to save on taxes, you're doing yourself a disservice, because once again, it's usually your biggest expense, biggest line item expense. Work on it.
Yep. So I'm going to change up the order a little bit from what we talked about.
Whatever you want to do.
So I'm going to throw you guys for a loop. Let's see if you guys can. I'll start with an easy one: depreciation.
Woo!
Then we'll get harder and harder.
It is an easy one, but it is one of the most powerful ones.
Yep.
Right. And it's why a bunch of real estate professionals don't pay income tax for years. You buy these bigger buildings, commercial real estate, you're buying bigger buildings, and with the bonus depreciation, that is still in effect, as I understand it, is you can really maximize your depreciation deduction.
It just got reset with a new bill we're not going to talk about.
And so whatever month you buy it, you can take a full year depreciation that first year, which really, really helps. So if you close the deal in November, you may make a little bit of money in November, December, but you get a whole year's worth of depreciation on that larger asset. That's going to be bigger than your income. So then you're going to get that depreciation loss and be able to apply it to other income, hopefully.
Yeah, carries over.
Yep.
Right?
This is the main reason we don't buy trucks on December 31st, right? You ever hear those idiots who are out there like, oh, this is the last day of the year, I need to buy a truck. Like, no, just buy. Wow, I just spit all over the place. That was gross. You just buy real estate, right? Because these are what we call phantom losses. You don't have to spend the money in order to take the loss, right? So every year, regardless of spending money on that building, you get to depreciate a little bit of it to the tune of a lot of money. It's 5-10%. Sometimes more on the total value of the improvements on the deal, right? Which is for us, our average deal size is $6-7 million bucks. So if you're taking the improvements on that, you're depreciating 5. If you can write off like 13% in the first year, is I think our starting number. I think it's even higher than that, man. Yeah. It's a big number. And again, you don't have to spend that money. It just goes on the profit and loss is like, nope, loss. And you get to keep.
Well, if it is December 31st and you need, $80,000 of tax write-off that day, okay, maybe the truck's the only way to go.
Sure.
But the thing about the truck is that you're not investing money, you're spending money that you're never going to get back. And with real estate, you're investing the money and you still get the tax deduction. And where the truck, you may, put down 80 and you get 80. The real estate, you're investing, let's say a few hundred, you're getting almost a few hundred in depreciation. And the investment stays in there, right? It earns a return and you get the tax benefits.
Well, and the value goes up.
Yeah, and the value goes up. So you're getting all these benefits way above. The truck's going down in value.
Going down day one.
And the truck doesn't produce income on its own. The property does. And so there's lots of benefits to buying an asset at the end of the year for tax deductions versus buying a truck. All right, next.
Okay, so that's a good segue into the second topic, which has to do with the depreciation. That's cost segregation. How does cost segregation affect depreciation?
Yeah, so depreciation of non-residential commercial buildings. It's a mouthful. That's the technicality is 39 and a half years, right? Residential buildings is 27,
something like that,
27 and a half or something like that. So basically residential, commercial, meaning apartments, right? People live there, but it's still commercial property. You can depreciate that a little faster. But our shopping centers, industrial warehouses, whatever it is that's non-residential, you depreciate over 39 and a half years. This goes in and it's a big study and it says, hey, the reality is it's got a lot of pieces that depreciate or have a usable life of way less than 39 and a half years. Let's separate all of those smaller components out, like light fixtures, wall receps,
doors, HVACs, roofs, parking lot,
all of that stuff, and allows you to front load your depreciation. So instead of your depreciation schedule being a flat line, like think of 39 and a half years, you're taking 139.5%
a year
every year. Now the first year you may be taking 15, 20%, and then the next year 13, 10%, then the next year 6, 7%, and then it just really flat lines and gets low. So later on in the depreciation schedule, you're barely depreciating anything. But as we learned in the time value of money, $1 today is always worth more than $1 tomorrow. So it's very advantageous to do these cost segregation studies and front load the depreciation.
Yeah, and just as an example, guys, try to think about it like this. Let's say the cost segregation, instead of 39 years, you depreciate a bulk of it in the first 8 years. And you save, let's just call it $500,000 on your taxes. Okay, let's say it's a big property. Well, okay, you get to invest that $500,000 now. You didn't have to pay the tax. So you have this $500,000 you would have paid in tax, but now you're not going to. You're going to invest that money. Just do the math. What is it worth in 20, 30 years, right? Instead of waiting 40 years to get all that savings, you get it in the first 8 years. Now you got 31 years to invest it. And to equal that original 39, that money's worth millions and millions of dollars. And so that's how powerful it is if you use it correctly, is get the money in your pocket today, save on tax today, invest in assets, right? And 10x that money in the 30 years or triple it, whatever you want to do with it. So
real example, Most times an investor writes us a check that first year, that same tax year that they wrote us the check, they're getting a loss equal to that amount. Second year is typically a little bit of a loss. Third year, we may start to see them pay taxes, and they've gotten cash flow for 3 years now. And year 3 is when we're starting to pay taxes.
A little bit of tax.
A little bit of taxes.
Yeah.
So you've got years to go and invest those tax savings. So by the time you're paying the tax bill, you could be paying it with
Proceeds from your tax advantaged investment.
Yeah. Exactly.
Yeah.
Okay. All right. Next, also related to depreciation is how it relates to a real estate professional versus a non-real estate
I think that's good to do
professional
this
on
one
your tax return.
because what some of you are going to say is, well, okay, Joel, I got all these passive losses, but I don't have passive income to offset it, so I can't take advantage of it. You're capped at like $3,000 a year on your passive losses. You cannot utilize that against active income.
So we need more frame of reference. Guys, some high W-2 earner, some high earner makes tons of money and they're buying commercial real estate on the side because it's a great investment. They're looking for depreciation. We got a little bit of color here. This person has all of these losses from real estate that they bought to offset their high active income. But because the real estate is passive and their active income is active, we can't use them to offset each other yet. So we need to make that commercial real estate investment not passive. We need to make it active, and then those active losses can offset this active income.
Yeah.
Okay, so then in a real quick nutshell, how do you do that? Okay, and the tax code says you've got to maybe spend, what is it?
50% of your time.
50% of your time.
There's a few requirements.
Or 1,000 hours.
With a minimum of like 750 or 1,000.
750 maybe. Yeah. And so you can do this. What really helps if you have a spouse that maybe works less, a part-time job, or doesn't work at all, and they become the real estate professional, and they're managing the real estate investments. They're looking at future investments. They're maybe drive a few neighborhoods. Maybe they have some online activity. Boom. Now all of a sudden they're a commercial a real estate professional. And if you're filing jointly, you can use her status or his status as a real estate professional to offset the passive losses against the high income earners W-2.
Yeah, and just investing isn't enough to be considered under these 750 or 1,000 hours, right?
No, we tried that.
Yeah,
we've tried that. As a general rule of thumb, your accountant works for you, and you should have the approach of kind of telling them and leading them to some of these strategies, right? We've had to do that a lot. It's very interesting thing about CPAs, but it's rare you find one that gives you advice. I've almost heard rumors that it's hard, like it's almost not allowed for them to give you advice. Like they kind of have to be told to do certain things. It's weird, but you just need to bring this up. I am a real estate professional, and you need to give the supporting documentation, right? They know the tax code. If you walk in and you say, hey, you know, my spouse or myself, we spend 750 hours a year. We've got all these real estate investments. It's basically a full-time gig for us. We're a real estate professional. 9 times out of 10, your CPA is going to say, okay.
Yeah. Or just ask them, hey, what do you need from me to qualify as a real estate professional in order to write these passive losses off against our earned income? Yeah. And then let them tell you, and then just make that happen. But it is possible. You can do it. It's a little harder if you both work really demanding careers. It'll be a little harder, but it can be done, and it is a hugely valuable thing because sometimes, especially if you're buying on your own, well, you're getting 100% of that depreciation. And if you're buying any building of size, even if you're a doctor making $500,000 a year, there's years where I've gotten over $1 million in depreciation, phantom loss, and I just wipe out that $500,000, zero tax. And so that's how powerful it'll be. I mean, it could save you $250,000.
Yeah.
I mean, that's in 1 year. That's amazing. And so this is a really strong one if you can put yourself in a position to utilize it.
All right, next, utilizing a 1031 exchange.
We've covered this. Braden, give them the quick rundown.
Yeah, so if you sell a property and you want to defer your taxes, not get rid of them, it's kind of a loophole. You defer the taxes as long as you don't get the money and you use an intermediary, i.e. a title company or an attorney. You do not get the money, right? You go to the closing table, they wire somebody else the money. And then that person holds the money for up to 180 days. You've got 90 days to identify some like-minded stuff. But long story short, you have to replace it with like-kind real estate. So if me, Braden Sheik, sold a big commercial real estate asset that I bought for $5 million and I'm looking at $4 million worth of gain, as long as I go replace all of that money in other commercial real estate and I don't touch the money, I use the intermediary and I follow the protocol correctly, which is very easy to do. It's a very common practice. Then they allow me to defer that tax and I just continue my basis. I just continue my basis in that new property. So if I have $1 million basis and I just went and bought a $7 million property, then that's what it is. And the tax liability, as long as you continue making good investments, of course, gets bigger and bigger and bigger and bigger and bigger, right? Because you can see how that $1 million tax liability in a $5 million deal can be $1 million tax liability in the $7 million deal. And then you exchange that one, now it's $1 million tax liability and potentially $100 million worth of deals, right? You can see how if I did this at my young ripe age of 29 and I kept going until Brian's less ripe age, then I could have a lot of money deferred in real estate. And then boom, you kick the bucket and die. Because that happens. That's pretty much one of the only guaranteed things other than taxes is your children and your heirs get the step-up basis. So they immediately don't have to pay taxes on your lifetime of deferred real estate transactions. Yeah. Like you've deferred it forever. You did it correctly. They don't have to pay taxes on that. And even better, they now get to start depreciating it again at market value. Yeah. So that $100 million real estate portfolio that you had a taxable basis of $1 million in, they now get to accept that, no tax liability, and depreciate it again. It's ridiculous.
Yeah, and speak with your CPA because I'm not exactly sure. Like right now, I think the exemption on estate tax is like $25 million or something. And so I'm not sure if you have a portfolio that's bigger than that.
And that's assuming it transacts. If it's in a trust, it's not technically transacting.
Yeah.
They're just the new beneficiary. That's not a taxable event either.
Yeah. So it just gets complicated. Make sure you're consulting a professional. But either way, 1031 is a good tool you can use to push the taxes way down the road. A couple things to remember. You have to replace the value. So if you sell a $4 million building, you got to buy at least $4 million worth of like-kind exchange property. Like you said, you carry your basis in. So if I have a $4 million property in my basis, I've depreciated down to $1 million. Then I carry that $3 million of gain into the new property. Let's say in his example, you buy $7 million. Well, now my starting basis is 4 because I brought $3 million of taxable basis into the deal.
Right.
You have to identify in 45 days, I believe. You need to close within 180 days. But overall, you should look into that strategy. What's the next one?
Last one is let's say you want to buy some commercial real estate, and the money is in a brokerage account. It's in stocks, mutual funds, ETFs, et cetera. So rather than going in and selling those equities, you borrow against them. So that's
I love this one. I love this one, and I don't actually utilize it yet. I'm looking into utilizing it. But here's the thing: let's say you've built up a nest egg of $1 million in your retirement account, and you're like, man, I don't want to sell that stock. I'd have to pay capital gains on it, and then to use it to invest in real estate. Plus, that stock might keep going up, and so this strategy allows you to take advantage of the best of all possible angles. And so what happens is you have this portfolio of stock, and let's say it's going up, it's earning you 9% a year on average. Okay, and you have a lot of taxable gain there, you don't want to sell it. All you got to do is you go to a bank and you put a loan or a line of credit basically against that.
Or the brokerage company if it's
or the brokerage company. And so let's say on the $1 million, you get a 70% LTV loan or 60. It's not going to be super high leverage. And so you get access to $700,000. What's going to happen is you're going to take that $700,000 and you have it available to put into a real estate deal that could be earning you 20% return. You get to, if done the right way, you get to deduct the interest that you're paying, right, on the loan.
Yeah.
You haven't touched your stock, so that stock is still growing at 9%. You have no taxable event. So now you have $700,000 over here earning 20%, earning depreciation, going up in value. You got your $1 million stock portfolio you haven't touched. It's going up in value at 9% and no taxable event. And then you've got this small percentage interest of 5% or 6% or so that you're able to deduct against your income. And so that's what the whole program looks like.
Yeah, nice. Okay, so there is a downside, and that is if the value of your account, let's say the stock market starts plummeting and it's a lot of stocks, then there could be a margin call against you, right? If the value of your account starts going down.
Could be.
This is a fancy way to trade on margin. Is what it is. And essentially,
that's what it is.
Instead of trading on margin and leaving it all in the markets, you're trading on margin. Again, let's assume you have $1 million in. Let's take $500,000 out, trade on margin. We're just taking that out in cash. We're not reinvesting that back into the market. We're just taking it out in cash, reinvesting in real estate, like Joel said. But like you said, when you're investing on margin, when you're using your stock portfolio as collateral, it's only as good as the value of those stocks, right? So when shit hits the fan, they're going to have these parameters built into the loan saying if the value of these stocks goes below, using our $1 million example, goes below 600,000, let's say, then we're going to sell all of the entire portfolio to cover the $500,000 loan, and then you're left with nothing.
Yeah. So you definitely don't want that to happen.
If it gets close, you could put more money into it.
So if you've got a bunch of
of
other cash or other access to capital, then great, you can be more aggressive on this loan. If you don't, then I would say go for 50%.
Yeah.
Right? 50% of the $1 million, you're going to put in this real estate deal earning you 20%. And you're going to keep the $1 million earning the 9 or 10%.
Yeah.
And look, the Great Recession or whatever it's called in 08, what did the stock market lose? 45%?
Something like that.
Peak to bottom. And then within, a year, it was 30, 40% higher back. So not above the previous high, just above the bottom. So I think you're really, really safe at 50%. Maybe 60%. Fine too, and you keep an eye on it. But this is a very powerful strategy. If you're a little older like this guy, and you've got a big retirement account,
like
definitely should look into it.
This is the billionaire strategy. This is how these people don't pay taxes, right? Is because they have,
all these strategies.
Millions and millions of shares of Tesla stock or Amazon stock. They don't have to ever sell it. They just leverage against it. The stock goes up. So then they're like, it's this self-sustaining cycle. The cash that they're taking out in loan dollars,
and their stock price is going to continue to go up.
100%.
So it's a great strategy, guys. Borrow, what is it? Buy, borrow, something, die.
I thought we were talking fly, float.
No, we weren't doing that one.
Okay. Different one.
Trying to know.
Anyway,
that's the 5 that we had for you today. How to save money on tax hacks, let's call it, whatever.
We've been focusing a lot on taxes, and it's funny because it's July and taxes are done. But anyway, dollar saved is dollar earned.
Yeah, well, that's why you can prepare for this year.
Yeah, for sure. Okay, we will see you guys next week on how to invest in commercial real estate, and happy 4th of July. We missed that. Happy 4th of July, guys.